G'day folks, Adam Renouf, Renouf and Partners Financial Planning, Director of Cumulus, on behalf of Renouf and Partners, Array Financial Services and Mainline Financial. I'd like to welcome Damon Gosen to join us for our inaugural coffee chat on ETFs over coffee. So welcome, Damon.
Thanks, Adam. Great to be here.
Well, excellent. Thank you. So the whole purpose of today is a brief chat about ETFs over a cup of coffee, so we can have you out of here in about 5 or 6 minutes' time. So thanks, Damon. Now, a couple of the important things that we need to go to: pledge your allegiance to the flag, standard disclaimers, general advice, nothing specific. Damon's going to have his own Van Eck on there as well, so we'll go through that shortly. So, most important thing is now to be a bit of a pump up about Damon. He's one of the directors of business development in Victoria. This man knows his stuff, and Van Eck is one of our favourite organisations that we deal with in this area. Nice little profile there, as we can see, and I'm sure Damon would be more than happy to answer any specific Van Eck questions that you may have, but rather than forward them through to Damon, send them straight through to us, and we can then filter out some of that stuff for him. Van Eck's disclaimer, so that covers your legal liability, so you don't get locked up and sent to jail, even though isolation might seem like that at the moment, but that's a whole other issue.
Yeah, it feels that way. It feels that way anyway. It wouldn't be a great change, really. So.
Exactly.
Now would be the time to do it.
Now all the rubbish parts out the way, let's get to the important bit. All right. What's an ETF?
Okay, so for new investors into ETFs, the term can sound a little bit complex, exchange traded fund, but it really isn't. It's really simple. So I'll take the first two letters, ET, exchange traded, just basically means you buy and sell on an exchange. So like the Australian Securities Exchange, the ASX. So, and like a fund, so the F part of it, it's a diversified basket of underlying securities. Could be a portfolio of shares, could be a portfolio of bonds or commodities. So really, in essence, it is a diversified fund that trades on an exchange. So it's best of both worlds, really, between listed shares and managed funds.
Awesome. So what are the key benefits of an ETF?
So in terms of the key benefits, I think first and foremost is that tradability. So by being able to buy and sell on market, you have a greater level of tradability than regular investments or managed funds. You also have the price transparency and price discovery. So you actually know what you can buy or sell at during the trading day. So unlike a managed fund where you put in a redemption order, you're not sure what the actual price is, or a buy order as well, there is that pricing discovery, that additional layer of liquidity. Now, one thing with an exchange traded fund in terms of benefits is there is so much choice available. You can buy broad Australian shares or broad international. You can buy individual sectors as well. So you could buy an infrastructure exposure. You could buy a corporate bond ETF. There's just so much variety to enable you to use an ETF as a building block for a portfolio. Now, one of the big things is the transparency of an ETF. Investors can have a look on our website every single day and see every holding that sits under the hood. So it doesn't matter if it's a fund that's got 300 stocks in it, you'll see all 300 and the exact weightings as at close of business the previous day. We don't hide anything. What we are selling is a product and a product structure that has such high levels of transparency. And one final point, actually I've got two final points, may as well give ETFs a real plug while I can. The costs associated with it. ETFs are generally index tracking funds or passive investments, and as a result, they tend to have a much lower management cost than traditional managed funds. Now, the final detail, and I won't bore you all, especially with a short session like this, but I'll suffice it to say ETFs offer tax advantages and tax efficiency above and beyond what an unlisted managed fund would do as well.
Awesome. So transparent, tax effective, and cheap.
Exactly.
And liquid, right? That's the other important thing most people don't realise. So, so what are the negatives of an ETF then?
Now, it won't be surprising that you've got an ETF guy that you're talking to right now that can't come up with a great deal of negatives, but I'll do the best I can. I'll be genuinely impartial in doing this, there's probably two negatives that I can think of. One's probably some people like actively managed vehicles, i.e. they like a portfolio manager who's picking the best stocks or the cheapest stocks and trying to add value above and beyond an index. And generally speaking, most ETFs aren't active, they are passive vehicles. So for some investors that have a preference for active, then ETFs in the past may not have been for them. This is all changing because there is huge evolution in the world. We actually do have an active ETF in our suite, and a lot of what we do could be described as non-traditional indexes. So I'd kind of say that's a bit of an iffy negative and a changing negative. One is, being a listed security, every time you transact, there's a brokerage cost. And so for small trades, sometimes that brokerage cost can be quite an impact. So if you're placing a few $100 order and you're paying $30 brokerage, well, that's probably not a great idea. So that is that's probably the only real genuine negative that I can think of.
Excellent. So you've sort of covered off the next couple of questions in a roundabout way as well. So how do you buy those ETFs, any ETF, as you said before?
Yeah, so you buy and sell on exchange. So every ETF has a code, a ticker, just like a share. So if you're wanting to buy our Van Eck Vectors Australian Equal Weight ETF, the ASX code is MVW. And then it's a matter of just placing a trade on market with that. There are a few tips and traps in terms of when to trade. At the very start of the trading day and at the very end, there are times to avoid, just tends to be when the bid-ask spreads, which is another implied cost, they tend to be a little bit wider then. So hence the reason I would always say talk to your financial advisor about this, because there are some things to be aware of. But it's very simple to transact.
Excellent. And Van Eck has also been not aggressive, but active in the market of providing direct ETFs to superannuation platforms as well.
No, absolutely. So, I probably, that's a nice segue into a benefit that I forgot from a moment ago. It's the accessibility. You can buy and sell on market, on an exchange through a broker or an online trading platform. Or if you do actually have your superannuation, say within a superannuation platform or wrap account, then ETFs are readily available there as well as an investment vehicle.
Excellent. So what is the difference in fees? Now, I know most people, we're doing this as a sort of a basic approach. So what's the difference between an ETF or a managed fund in fees?
So most managed funds and most money that sits in managed funds in the Australian market are in actively managed funds. On average, the management cost for a wholesale actively managed, say, Australian equities fund might be 1%. Some might be a little bit lower. Some are higher. Some have got performance fees built in as well. For an international fund, the fees are typically even higher again. So a lot of the mainstream funds that are very popular and got a lot of money sitting within them might be 1.3% or thereabouts. Typically for comparable exchange traded funds, the fees could be as low as, for just very simple index methodologies, as low as 0.1%, 0.1 or 0.2. Most are probably around the kind of 0.3 or 0.4 mark. So when we broadly talk, we'd kind of say most ETFs in our suite are 1/3 of the cost of a comparable managed fund.
Excellent. And because of the structure, so much easier to buy into them at a lower value. So you can buy 10 grand's worth of ETF where you've got to buy 100 grand's worth of managed fund to get the equivalent.
Yeah, exactly.
Cool. What's the difference between an actively managed fund and a passively managed fund?
Okay, so the bulk of ETFs are index tracking or passive. So your clients would be familiar with hearing of things like the S&P ASX 200, which is the largest 200 companies. So that's an index. or the S&P 500, so the biggest 500 US stocks. So that's an index strategy or a passive strategy where the objective is just to purely track the performance of an index. Now, I don't have the actual numbers, but I did read a statistic that there's now more indexes than there are actually underlying securities. And so I've just given a couple of just mainstream examples, but there are a ton of different indexes. We have, as of today, 25 ETFs and 24 of them are passive. And they track very different indexes as well. And an active fund actually is just something where someone or a team or an investment team, they are making active decisions as to what to buy or sell. So we have an emerging market bond fund. Our view as a firm, as an investment firm with a huge passive business, but a history in active funds management, is that that's an asset class where you don't want just an index. You don't want to just hold a bond because it falls in the index. You want someone at the helm to make sure you're actually getting the right exposures in there because of the inherent risks within that asset class.
Yep. One of the other big benefits, I suppose, and you'll probably cover this off on the next question when we talk about Van Eck, but ETFs also give people in Australia a substantial or an opportunistic exposure to international equities, where otherwise it's basically non-existent.
Oh, absolutely. And that has been probably because ETFs are playing catch up in Australia. Like we jump up and down beating a drum saying that the industry's gotten to $60 billion. But when you think about $2 trillion in superannuation, it's a drop in the ocean really here. We're probably about 5 years behind the US at least in this regard, where there's trillions of dollars in ETFs in the States. And the initial push was self-managed super fund investors that were typically very heavily represented with Australian shares, diversifying their portfolios by getting international exposure. We've seen that broaden out to other asset classes like bonds and gold and other types of holdings to help deliver the investment objectives for each individual client.
Excellent. And finally, why Van Eck?
So I would say, firstly, when it comes to picking an ETF provider, go for someone with global scale. So we've been in business for over 60 years. We take a very long-term view on markets. We are a very big funds management group, so we've got well in excess of $80 billion under management, which means the arrangement, like in terms of running funds, getting very good brokerage rates. We've got all that scale to be able to manage things at as low a cost as possible. So I would say that's an important part. The second bit about us is when you think about the bulk of the ETF world being passive or index, do we really think that the people at Standard & Poor's or S&P that sat around creating indexes decades and decades ago ever imagined that trillions of dollars worth of investment product would be linked to those indexes? I think the answer is no to that. Really, they were just meant to be representations of what was going on in markets, not something that was actually investable unto itself. So we always take the view, which is in each asset class, what is the best type of way of getting exposure? So in Australian shares, where it's such a concentrated space, we do something very different. We equally weight the portfolio to give more sensible diversification. In international, we're very well regarded for some strategies that focus on quality companies. So screen on simple metrics, but sensible metrics like return on equity or leverage or earnings stability. And not overpaying for companies, so making sure companies are attractively priced as well. So I'd kind of say, in terms of the why Van Eck, we're very differentiated in that we really think about what the best type of approach is in each asset class, and also like being very forward thinking about where investors should have exposure. Are there investments that are underrepresented in portfolios that really shouldn't be, that are emerging asset classes that investors should hold?
Fantastic. And for us, transparent, easy to get information for clients, etc. So, no, very, very good to deal with. So that's much appreciated. Well, that wraps us up for today, Damon. So thank you very much for your time. Like I said, this was a coffee talk just quickly on ETFs. If you'd like any other information, please email myself, Steve, or Alex direct. And if you'd like anything from Van Eck, please let us know and we'll get that information from Damon. Please join us next week. Steve Mains is going to be talking to Michael Watson from Latrobe Financial. So thanks, guys, and have a good week.